Welcome back again, Personal Finance Gang. This is going to be a brief section mostly on exchange traded funds. I'll just mention another type product and then we'll summarize a few things on mutual funds and ETFs. So these are two cousins of mutual funds that we'll talk about: exchange traded funds and real estate investment trusts. And let's start off with some info on exchange traded funds, or ETFs. These ETFs trade just like stocks on the stock exchanges, so you need a brokerage account to buy these. But most of the ETFs track individual indexes, so they're mostly indexes, and they're things like you can get the S&P 500 index, small company stock index, value stock index, you name any category you want, and there's probably an ETF to track it. Okay, but they're not actively managed. In other words, most of them are not trying to pick winners. And because of that, go down here on this list of things about ETFs, because they're mostly tracking indexes and not trying to pick winners, they have pretty low expense ratios for the most part. That means they're not charging big management fees. And remember from last time, where do those fees come from? They come right from your pocket. Now, you do pay brokerage commissions on these, but this used to be more of a big deal. But most places right now are not, or many places, I don't know if all, but you don't have to pay brokerage commissions at a whole lot of places. And Vanguard, even before they did away with most of their brokerage commissions, let you trade their ETFs for free. So this commission bit is not as important a deal anymore. You just need a brokerage account. And if there is a commission, you might not want to trade the ETFs there, but you need a brokerage account and you're good to go on most of these. And you can buy these on margin and you can sell short. These are two topics we're not going to cover, so don't lose any sleep over them, but I'll just tell you briefly what they are. When you buy on margin, that means you can borrow money from your broker and use borrowed funds. You generally have to put up about half the funds. But if you had $1,000, you could probably buy $2,000 worth of ETFs through a broker if you had a margin account. So you're borrowing money, you have to pay interest on that. So that's one thing you can do with ETFs that you can't do with mutual funds. And another thing, selling short, is betting that basically that they will, whatever it is you're selling now will drop. So with selling short, you sell the stock or the ETF now, even though you don't own it. That seems kind of weird. And then you buy it back later, and you hope it goes down to a lower price for when you buy it back, and then you make money. The downside of this is there's no limit to how much you can lose when you sell short, but that's for another class. But you can do this with ETFs and you can't do that with mutual funds. Like some big name ETFs, some of the first ones were spiders. You had to, originally ETFs all had to have cool names, so like there were spiders. And then there are diamonds, the Dow Jones Industrial Average, and the cubes, a bunch of cubes, the NASDAQ 100. I don't think this one had a cool name, but anyway, you can find ETFs to track almost anything you want. So etfdb.com for DB for databases, one site I know that has lots of mutual funds, but you can find, or ETFs, you can find an ETF screen, other ETF screeners. And let me just pull over, so I keep harping on Vanguard. I don't get any money from them or anything. But here are the Vanguard ETFs. They had more mutual funds, as I recall, but they have 74 ETFs. I just did all. So they've got bond ETFs, same as you had with mutual funds. And then now they've got stock ETFs. A lot of these are the same. So as what they had for their mutual funds. But these things, again, known for low expense ratios. So here's the expense ratio column. I don't know if you can see this on your screen there, but the growth ETF 0.04% expense ratio, large cap ETF 0.04, mega cap ETF 0.07. I mean, so these are known for. Total stock market ETF is only 0.03%. So charging pretty darn close to nothing to get in, like with that total stock market ETF, probably get in on 2,000 or more stocks, part ownership or indirect ownership of those. And we got mid cap ETFs, small cap ETFs. One that I like as well, the where to go? Those are international bond ETFs, but you can get the whole world, one fund that you get stock from all over the world, or you can just get outside the U.S. Total International right here. I lost it. Yeah, there's the Total International Fund. This gives you exposure to pretty much the rest of the globe outside the U.S. And then they've got some more specialized ETFs, consumer services, consumer staples, energy, financials, healthcare. And these, one thing, if you notice from before, the Fidelity mutual funds, I didn't point this out at the time, maybe I did, but we looked at those sector funds, and a lot of them had expense ratios of 0.75%, versus most of these Vanguard ETFs that look at sectors have a 0.1% ratio. So any of the Fidelity comparable funds would have to beat these by 0.65% just to break even. But anyway, so that's a little bit about some Vanguard ETFs. And yeah, I've touched on this a little bit already, but you can find ETFs to fit pretty much anything you want to do. Do you want U.S. or international stock? So I showed you some of that with Vanguard. Do you want sectors? Vanguard is not the biggest name in ETFs. They are there's thousands of them out there, ETFs. But you can pick different sectors. Do you want international bonds or U.S. bonds? Vanguard had a decent selection of bond ETFs. Do you want to be in oil or natural resources? There are ETFs designed to track that. Do you remember this term, bearish? You're betting against the market. You can find a fund that's designed to go up when the market goes down. Do you want a fund? You can get a fund that borrows money, so you don't have to. The fund itself is borrowing money, so your returns are magnified. So in theory, if you buy a 2x fund and the market goes up 2%, you'd go up 4%. That sounds great. What's the bad side of that? If the market goes down 2%, you'd go down 4%. So I'm not recommending any of these down here, the bottom 4. Then also another category, and there's more, currency ETFs. Do you think the dollar will go up in value? Do you think the British pound will go up or down in value? You can find ETFs that do that. I'm going to show you some examples of some of these coming up. So I mentioned commodity funds or ETFs. So gold, silver, livestock, natural gas, more. You can find ETFs designed to match the prices of these things. But I got a note here, they don't always move in sync with the things they track. There are issues because these, with like the livestock ETFs, they're not buying livestock. They're buying securities somehow tied to the price of that. And sometimes things between the securities and the actual commodity do get out of whack a little bit. So they're not guaranteed to perfectly do what you'd like them to do. I would consider these a little riskier, although I've heard several recommendations, especially of late, have 5% or so of your money in gold. So I think GLD is a big name in the gold ETFs, probably, let's see. But anyway, I've never been a big gold fan because, well, the only reason it has value is because people think it looks pretty. But anyway, gold is often used as a hedge against inflation, and when things are bad, people can have their gold. There's a limited quantity of that for the most part. Like I said before, you can pick ETFs tied to different currencies that will make money if the currencies go one way or another. You short ETFs. Remember, I said shorting is you're betting against something, and if you're short on something, are you bullish or bearish? You should remember that. You're bearish, so there's my bear. But if you can find ETFs that will go up when the S&P 500 goes down, they can go up when oil goes down, they go up when gold, there's plenty of them out there. If you search for bearish or short ETFs, you should find them. Again, these don't always move exactly the way you'd expect. They try to. I mentioned the leveraged ETFs already. You can do 2 times. So they're designed to go up, this on a daily basis, but go up twice as much as the S&P 500, go up twice as much as the Dow. This is going twice as much in the opposite. So they're trying, you can, these are getting riskier. I'm not necessarily recommending any of these, just telling you your options. And if most of these, the top 2, you're betting on them, you're bullish. So I've mentioned this before, ETFs famous for low expense ratios. You do have to pay brokerage fees, but again, that's probably not much of an issue, if any, anymore. So some investors, though, depending on your circumstances and all, you may be better with a no-load mutual fund, or you may be better off opening a brokerage account and just buying ETFs. So if you want to be able to get in and out of the market on short notice, and I actually have wanted to do this some of late, so like I'll log on or be watching the market at 10 a.m. and say, geez, I want to sell now. Which one of these would I and that's not normal for me. I'm more of a long-term focus, except for coronavirus days. But which of these should I use if I want to be able to get in or out of the market like immediately? So right now it's 137. If I wanted to buy right now, ETFs are your only choice if you want to be able to get in or out quickly. With mutual funds, if I want to sell right now, I place my sell order and I'll get the end of the day price. If I want to buy right now, I place my buy order and I get the end of the day price. They calculate the net asset value at the end of the day, and that's the price you get, whether you're buying or selling. With ETFs, you place your order right now and it's processed within a few seconds. You got the current market price. So if it ended up going, the market ended up going up 2% after you bought, you get that 2% during the day. You get that 2% gain. If it went down 2% during the day, well, you got in and you've got that 2% loss. Usually this isn't much of an issue, but I don't know, ETFs are more convenient sometimes. Now, if you want to invest just a little bit each month, which should you use ETFs or no-load mutual funds? If you have any brokerage fees at all and you're just putting in a small amount each month, you definitely don't want to do ETFs. If you don't have brokerage fees and you can buy small amounts with ETFs, then you want to look at the expense ratios. But one thing with ETFs that you don't have to worry about with mutual funds is you want to invest $100. Suppose your ETF is priced at $70 a share and you only have $100. Well, you can only buy one share. With a mutual fund, you just send them however much cash you want, and they give you fractional shares. Okay, so small investors, the fractional shares, if you're going to be doing dollar cost averaging, odds are you'd be better off with a mutual fund. Just because of that, you don't have to worry about the number of shares, etc. And you can't buy fractional shares most of the time. Although you could get, when you get dividend payments, they may end up giving you fractional shares. But anyway, you place your orders for whole numbers. Now, if you plan to buy and hold for the long term, so you want to buy and hold for 20 years, which should you use? In this case, ETFs, if you find an ETF in a mutual fund that does the same thing, ETFs often end up having slightly better or lower expense ratios. So the ETFs may have an edge there. All right, so that was exchange traded funds. You need a brokerage account. You want a brokerage account that's not going to charge you a fee for buying and selling the ETFs. There are plenty of those out there. Or maybe even if they just didn't charge a fee for their ETFs, make sure you like their ETF selection. No-load mutual fund, again, if you're going to do a little bit a month, you might be better off with a no-load fund. Just depends on your personal circumstances there. We're going to just briefly mention another alternative to mutual funds. This is a specialized category of securities. I mention this one just because it's, hey, you want real estate, you want commercial real estate. There are these things called real estate investment trusts or REITs. And you can get the actual, these with a mutual fund, remember you're buying into a pool of securities. So the company collects money, pools it, and buys a diversified portfolio of securities. With REITs, there are some that actually buy loans secured by real estate, but the more popular REIT type, maybe not more popular, but what we typically think of is you're actually investing in actual commercial real estate. So you buy into a company that pools your money and buys real estate. So maybe they buy apartment complexes, maybe they deal with malls, maybe they deal with whatever. Okay, different categories of real estate, commercial real estate. But this is one quick purchase. You get a diversified portfolio of real estate. You want to look into your REIT and see what it is they do. Or here's an even better, well, maybe not a better, but here's another alternative. You can find a mutual fund, and I haven't looked for ETFs, but yeah, I'm sure they're there, that will hold a portfolio of REITs. So instead of you trying to pick which REIT you want to be in, just get a mutual fund that has a portfolio of them, and you've got a diversified portfolio of commercial real estate. Okay, so that's just one quick alternative to mutual funds, another one. All right, to sum up, so mutual funds and ETFs are a good place to start out and a good place for anybody. There are some financial planners that deal exclusively with mutual funds and ETFs. Instead of trying to pick winning stocks for their clients, they pick, hey, let's go with the averages. The averages prevail. The market as a whole prevails and the low costs prevail. So, this is one, both of these are good options, for beginners and experienced investors. And either place you can start with, you don't have to have big bucks. But with one quick purchase of either of these, you can buy a Vanguard S&P 500 mutual fund or a Vanguard S&P 500 ETF. So one quick purchase, you get instant diversification. So diversification is the number one advantage of mutual funds. If you're, but you want to stick with no load funds. Skip the loads, skip the 12B1 fees, skip the back end loads, and look at expense ratios. So what are they charging you per year to manage this fund? Everything else equal, well, stick with no load funds, and you want low cost. Okay, this is true for mutual funds or ETFs. Nice low expense ratio. And if all this is stressing you out and you just want to get started saving for retirement, remember the target retirement date fund. So we saw the Target Retirement 2065 fund. So you can just pick this fund for your retirement account, your individual retirement account we'll talk about next week. And you're good to go. It's going to have some ups and downs that you'll be saving for 45 years. Trust me, there will be ups and downs in the next 45 years. But maybe this is one to remember. Hopefully we don't have one like this again. But anyway, so Target Retirement 2065 or pick your year. There's no 2070 right now at Vanguard. What they do is start in a few years, they'll add a Target 2070 for younger people coming on. But anyway, so that's some hints there on getting started there. I'm going to do one more video on in this series here, and on some places to get started actually to put your money now. But that's all for this, and I'll pick up with another video soon. Be safe out there.